Thanks, Axeli, and thanks, Jorge, because that was a really good introduction. So Jorge's told us about he's introduced the distributed exchange protocols and the role of tokens in enabling ledgers to support or to validate mutual issuance. And as an economist, I want to give the flavour, but it will only be the flavour because of time constraints, of the sorts of economic protocols that can be built upon gravity as Jorge's explained it. I want to talk about. One is to go back through those three tokens that Jorge introduced: the commodity token, the stake token, and the liquidity token. And I want to talk about them just a little bit from an economic perspective. And I also want to talk about performance metrics as our mode of measuring. That's an issue that John will take up in a little while, but I think it needs an economic angle as a link, if you like. So, first of all, the issue of tokens. Mutual issuance, as Jorge talked about it, means we're not proposing a centrally issued coin. Mutual issuance means we can break out of many of the conventions that are attached to central issuance, whether it's state issuance or private issuance of a central coin. Mm-hmm. And the most important freedom we get by breaking away from centrally issued coins is that we don't need a single form all money-like roles. We can have, indeed we want to have, different tokens performing different economic roles. And in the economy, as we conceive it, there are three irreducible economic roles. There's the commodity token role, as Jorge introduced it. There's the stake token role and the liquidity token role. So let me go through those again, even though Jorge's introduced them in a certain way. Let me go through them very briefly in an economic setting. We require a token that serves as a means of exchange of what we are calling commodities. And here we use the term commodity to mean not just raw materials, but as a way Marx used to describe anything that is offered and accepted in an exchange protocol. So we have an economy of mutually issued commodity tokens where effectively people trade outputs. So this is the token production, and hence it gives our token system an underlying value, or as economists and accountants like to talk about it, a fundamental value. It gives our tokens a fundamental value in the domain of commodity production. The second token is the stake token, which is a means of mutual stakeholding. That involves economic agents sharing interests in each other's endeavours. It's something like the way we think of equities in the stock market, although, of course, when there's mutual issuance, the analogy with equities in the stock market can only ever be partial. But we have mutual issuance of stake tokens, and these are linked to ownership and the risks of ownership. They involve agents taking on the risks, that is both the upside and the downside risks of their mutual endeavours with other agents. We call this the process of risk. We're not building an economy that is simply about competition. We're building an economy that uses individual incentives to be sure, but also the cooperation that is implied in risking together. And the third token that Jorge introduced was the means of mutual issuance of liquidity. And that can't be assumed to net instantaneously. Sometimes they will, but they can't be presumed to. So there has to be presumed to be frequently, in fact, almost always, a time interval involved in the process of matching. So there is the danger, if there weren't a liquidity token, that a non-match would lead to a freeze. So liquidity is required. This is the role of the liquidity token. It's a tokenized version of mutual banking. And anyone who has followed at all the work of the economist Perry Merling, who talks about banking in relation to ledgers, they'll recognise that there's some elements of Perry-Merling going on in our conception of the liquidity token. And I would just like to add here, I think the liquidity token is a really significant, conspicuous development in our token protocols, because I think the ability to secure internal mechanisms of liquidity is a really significant analytical achievement in building the viability and the reproducibility of this new economy. So I could elaborate these tokens in greater detail. I could even go into the development of a unit of account, but I think what I've said is sufficient to give the flavour of the grammar, and that word is important, and Axeli and Jorge both referred to grammar, but it gives the flavour of the grammar by which individual economic agents peer-to-peer creation of value. Ben will talk shortly more about the grammar, and John more about value. But I want to turn to the second issue I raised, which is about performance metrics. When we build this grammar, this distributed economy, we're not simply doing it because we can, because it's simply a logical exercise, but because we want to offer an alternative to capitalist modes of calculating. We want ways of measuring that don't imply or involve profit, but some other social indicators as units of performance. The sorts of performance we're thinking about here as alternatives to profit are dimensions like care for the biosphere, human care, the arts, human rights. It's not exactly for us to specify what these alternative social metrics will be, but those four areas I just mentioned give the flavour of what we're thinking will attract people to operate in our new economy. So the token system enables us to measure value by means other than profits, and indeed our difference from the radical markets people, who will be familiar to a lot of you, or indeed to our difference from movements for triple bottom line accounting, is that they frame value as profit subject to qualifications. We want to frame value as measured by things other than profit. Now, as I've said, John will address these issues, but what I've just floated is enough to say that when you have a distributed economy, how you decide to measure, to undertake measurement in that economy, becomes a protocol choice. Capitalism's protocols point to profit, with some caveats, but profit at its bottom line as its chosen metric, chosen in inverted commas, because, of course, it wasn't chosen. It's something that's been inherited over 250 years of the evolution of capitalism. It's never been consciously chosen, but it remains a metric. And we're opening the design issue of alternative performance metrics, which makes the issue of measuring a conscious social choice, and of course not one that we seek to resolve, but one where we seek to open ongoing debate. But what a great debate to have. What a terrific idea to say, rather than being burdened by this notion that everything is ultimately measured by profitability that we've had for so long, that we can make the design of social objectives an issue of protocol choice. So we're posing a measure of output and the economy's surplus by reference to these performance metrics. I could go on, but let me just finish with a few brief bullet points that follow from this introduction to performance metrics. First little point to make in conclusion is that the surplus that will be created in this economy is itself performance. We need to bring the various individual performance measures, those metrics that I mentioned earlier that might relate to the biosphere or to care or to the arts. We need to bring them into some mutual recognition. We can't reduce them to a single metric, but we can talk about them collectively as an economic performance, analogous in a rough way to the way that the capitalist economy talks about GDP as the aggregate measure of the economy. But of course, with GDP, everything is measured in terms of profitability. If it's not profitable, if it's not produced for the market, it doesn't get recorded in GDP. But we have multiple indices through which we're trying to measure the economy. So the overall performance of this new economy is not simply an adding up of these metrics, but their combination, as I say, itself a performance depicted in our fourth token called the EXA token. And the EXA token is really our equivalent to GDP. The second bullet point to make is that these performance metrics coming out of the operation of a token system mean that value has its basis in commodity offers and acceptance. That is, and this is critical, I think, our economy has value based in the fundamental value in the sphere of commodity exchange, and these commodities have a fundamental value in their act of creation. Accordingly, the EXA security, that is the asset that will be issued on capital markets, will itself have a verifiable value based in the capacity to confirm fundamental value. This is, I believe, a profound design attribute of the protocols of this new economy. And the final point I want to make, this approach to measuring the economy is what asks us as a clear alternative to capitalist ways of thinking, while at the very same time we operate inside a capitalist economy. As the performance of the capitalist economy comes increasingly under challenge, we offer the bailout. We are, as we call it, the big put, the way to put systemic risk of volatile capital markets back into the market, putting risk back into the market. If I were to pose this in financial language, I'd say EXA offers a short position and a long position. The short position is that we believe will have appeal to anxious capital market investors who are watching capitalism under challenge but can't find a place to invest their assets or their wealth outside of capitalist modes of calculus. We offer that alternative. Our long position is that we believe the economy whose protocol will be enticing for those who want to build an alternative value system, and that they can come and join in and financially support the economy that EXA is creating and live that long position as the alternative to capitalism. Okay, thanks. I'll leave it there and back to you, Axeli.
Cool. Hey, thanks, Dick.